Okay, let's talk about something that's kind of like a magic trick. How in the world do you put a price tag on a company that has a brilliant idea but is making absolutely no money? It's a world of huge risks, even bigger dreams, and some, let's just say, very creative math.
And really, it all comes down to this one simple question, right? How much is an idea worth? Sounds easy enough to ask, but when you're talking about a brand new startup with zero sales history and a product nobody's really tested yet, this question is honestly one of the absolute hardest to answer in all of business.
So what makes it so tough? Well, just look at this comparison. Think about a big, mature company. You've got predictable profits, tons of historical data, and plenty of other public companies to compare it to. Easy enough. A startup? Yeah, it has the exact opposite of all that. This huge information gap means you basically have to throw the normal rulebook right out the window.
And that is what creates what we're calling the valuation puzzle. Because of that giant information gap we just talked about, figuring out a startup's value becomes way less of a clear-cut science and a whole lot more of an art. In fact, one source calls the whole process an alchemy. I love that word. It perfectly captures this idea of mixing a bunch of different things together, a little bit of data, a lot of experience, some gut intuition, and yeah, maybe a little bit of trying to predict the future.
So, how do investors, specifically venture capitalists, or VCs as we call them, how do they find any clarity in all this chaos? Well, over the years, they've built a kind of toolkit that lets them look at a potential investment through two very different but super important lenses. And you can really break down these two mindsets pretty neatly. On one side, you have the science. This is quantitative, all about the numbers, focused on that big future payday, and it's driven by formulas. Then you have the art. This is qualitative, totally focused on what's here right now, and it's driven by good old-fashioned human judgment and experience. Let's dig into how each one actually works.
All right, first up, let's tackle the science. We're going to look at a really popular quantitative method that starts with the end goal in mind, that big, juicy sale, and then it works its way all the way back to today.
It's called, not surprisingly, the venture capital method. And the core idea here is to pretty much ignore today's lack of profit. Who cares, right? Instead, you focus completely on the future. The investor asks themselves, what could this thing realistically be sold for in, say, 5 to 8 years?
The logic here is actually beautiful in its simplicity. So step 1, you guess that future sale price. They call it the harvest value. Step 2, you decide what kind of return you need for taking on this massive risk. Maybe it's 10x, 20x your money. Then, and this is the key, step 3, you just divide that future value by your required return. It's really like starting at the finish line of a race and doing the math backward to figure out where your starting block should be.
But come on, we all know that numbers don't tell the whole story. Not even close. What about the team, the market, the competition? This is where that art lens comes in, with a method that actually tries to put a number on things you can't really quantify.
And that brings us to the scorecard valuation method. The goal here is pretty clever. You find an average valuation for other similar startups in that area. Then you adjust that average number up or down based on a scorecard of all the subjective things about this specific company.
Now look at how this plays out. See the weights here. Strength of the management team gets a whopping 30%. Why? Because at this super early stage, the people you're betting on are often way more important than the product itself. So if this team is stronger than average, say 125%, that's going to push the valuation up. But if the competition is tougher than average, maybe you scored at 75%, that's going to pull the valuation back down. It's a way to systematically apply your gut instinct.
So there you have it. You've got two totally different lenses, and they give you two totally different views. The venture capital method, that's all about the destination, what the company will become. The scorecard method, on the other hand, is all about the ingredients, what the company is right now. One's driven by numbers, the other by judgment.
Okay, so this all leads to the million-dollar question, or maybe the billion-dollar question. You run the numbers with one method, you fill out the scorecard with the other. So which one is the real number? What's the actual goal of all this work?
Well, here's the twist, the big reveal, the whole point of this alchemy, this entire mix of art and science. It isn't to find one single magically correct answer. That's not it at all.
The source material just nails it here. It says the true purpose of all this is to get to a reasonable starting point price. That's it. All of that analysis, all those spreadsheets and scorecards, they're just designed to get the investor and the entrepreneur to the same table so they can start talking. It doesn't end the conversation, it begins it.
So, let's wrap this up. What have we learned today?
First, valuing a startup is absolutely a blend of art and science. You need both. Second, VCs use these different tools to get a full 360-degree view of a company's potential. And maybe most importantly, that final valuation number, it isn't a final verdict. It's an invitation to have a conversation.
Which, leaves us with one last really fascinating thought. If this entire complicated process is just about setting the table for a talk, then what are the things, the strategies that actually decide who wins and who loses in that negotiation? That's a puzzle for another day.